If you're considering tax planning to make the most of your investments, you need to have a good understanding of how your investments are related to taxes. A good way to gauge understanding is by considering the 4 tax buckets. The first bucket is your taxable bucket. So anything you pay tax on each year, whether or not you pull money out, falls into this bucket. So what does this mean? It might mean bank accounts like CDs. It could be brokerage accounts, your mutual funds, or bonds, or even stock dividends. Anything that gives you a 1099 each year, even though you didn't pull the money out. Maybe you're just reinvesting. That falls in this taxable bucket. The second bucket is your tax deferred. Now there are 3 primary items that fall in the tax deferred bucket. Qualified retirement plans. That's your 401ks, 403bs, 457s, and IRAs. Non-qualified annuities also fall in this bucket, as well as savings bonds. Those are all tax deferred, so those are in that bucket. The third bucket is your tax-free bucket. Now there are only 3 things that are tax-free in today's world: municipal bonds, Roth IRAs, and properly designed life insurance. Notice I said properly designed life insurance. In fact, municipal bonds are not always tax-free, but for the most part they are. And then finally we have income and estate tax-free, and that's when you get into charitable trusts and other similar arrangements. Here's what you need to know. If you want to reduce taxes on your investments over time, you need to move assets to the right. One of the biggest mistakes people make is right here. They have a lot of money in qualified retirement plans. That creates a lot of taxes down the road. You want to move it to the right to help reduce taxation over time. That is the concept of the 4 tax buckets.